Hello there. This is Christopher Mirabile. I'm the managing director of Launchpad Venture Group in Boston, Massachusetts, and the immediate past chair of the Angel Capital Association, and now its public policy chair.
Well, thank you for joining us, Christopher. As you said, you're part of the Launchpad Venture Group. Can you tell us more about that?
I sure can. Launchpad is one of the largest and most active angel groups in the United States, based up here in Boston, where, thank goodness, the deal flow is just terrific. And we are a classic network model group. We capped ourselves at 150 investors about 7 or 8 years ago, which was a terrific decision, I think. And when I say network model, Hall, I mean everyone writes their own check. We have deliberately avoided adding a fund, a sidecar type of a fund into the group for reasons I can explain if that's of interest. And we do about $8 million a year invested into about 10 new companies a year and 20 to 25 follow-on rounds a year. So our current portfolio of active companies is about 65 active companies, and we've invested in about 100 companies over our 17-year history.
Well, I am actually interested why there's no sidecar fund. My experience with angel networks is for every 4 people I would ask to join the group, 1 would say yes, and then 3 would try to hand me a check to go into the fund, given they didn't have enough time to spend into it. But what was your approach to the sidecar fund?
Well, it's a philosophical approach. I think sidecar funds are fine. And I mean, they're a lot of work to run, and you can't really make much money running a subscale fund. So it's kind of a labor of love at the angel stage. But for us, it's a philosophical issue. We are very, very strong believers that angel investing is a contact sport, that the human capital you put in is as important, if not more important, than the financial capital. And funds introduce a couple of behavioral quirks. One is this notion that you can be passive and make money in angel investing, which I think is a myth. Now, that's not to say that you have to be all over every deal. Every portfolio has some companies that take up more of your time and some that take less. But we believe every deal needs an active lead and active supervision. And the other reason is that the funds can introduce some funky dynamics into the group behaviors. So, for example, you can have situations where the people in the group who are doing sort of all the work on the diligence feel like the people in the fund are kind of coattail riding. And, if you try to fix that with compensation, the managers end up getting compensated and getting carry on deals. And then you get into questions around whether the diligence person is recommending the deal in order to get the carry. And you can also get into tricky situations like who knew what when. So an investment goes bad and the person on the fund was the person who happened to be on the board, and did they disclose or not? Or you can get into situations where a bunch of individuals are in a deal and the fund is in the deal, and then it's time to do a follow-on and the fund votes not to follow on and abandons the individuals. So to our way of thinking, we're trying to culture a very active investor base, and we think keeping it simple and keeping people hands-on is the right way to do that.
Well, I've been an active investor and a passive investor, and you can guess which came out to be a better return, pretty much the norm. The passive almost all went to zero, and the active turned out to be pretty decent as well. But when you are active in these deals and doing due diligence and so forth, how many hours and how much work is really going into these things to achieve what you would say success?
Yeah, so as you know, Hall, there's different ways you can engage with portfolio companies. I mean, the biggest sacrifice is to be a board member. And in our view of things, that's about a 200-hour-a-year commitment between attending meetings, preparing for meetings, talking to the CEO in between meetings, helping with interviewing candidates, giving advice, relationship building, and so forth. if you have a 2,000-hour work year, it's about 10% of your time to be on a startup board and do it properly. The second next rung on the ladder down, is the board observer kind of a thing. And there's a little bit less prep associated with that. There's some relationship building. You're mainly looking at the meeting attendance and the travel. Probably the next rung down is someone who has a specialty and is an advisor, for example, someone who spent their entire career in enterprise sales and has agreed to meet with the CEO once a month to sort of talk for half day, sort of talk about the sales pipeline and building the sales function and so forth, and maybe is given some options in exchange for that work or not. Then there's just sort of the rank and file angel who, sees the CEO a couple times a year, sends the occasional article, reads the investor reports, maybe buys the CEO a lunch once a year, those kinds of things. And I'd be the first to admit that every portfolio has to have a mixture of actives and ones where you're on the board or you're putting in a lot of time, and ones where you're putting in less time because you can't possibly be adequately diversified and pouring 10% of your time into every deal. But on the ones where you're passive, you better be pretty darn sure there's some other people being really active.
Well, I've actually helped companies as a board member, and I think there is a balance between helping and the amount of time it required the CEO to work with the board. And we found out he was spending 2 days getting ready for each meeting and not selling the product, which was, of course, the main thing he had to be doing. So we had to cut back our board meetings to give him more time to actually do the regular work. So it's got to be additive and not subtractive at the end of the day. And too many board members could be distractive at some point for sure. But tell me more about Launchpad Venture Group. What do you guys invest in, and how do you make your decisions there?
So we try to invest exclusively in situations where we know a little bit about the company's business. We have a broad membership base, and the skills of our membership base really are sort of the indigenous skills of our region. And so probably the best way to think about us is about a third of our deal flow and a third of our portfolio is in classic enterprise tech. B2B solution need to have kinds of products for enterprise companies. So internet, SaaS, communications, those kinds of applications. That's a real bread and butter core competency for us, and a lot of our members come from the classic Massachusetts high tech kinds of companies, MIT and Harvard and so forth. So that's our bread and butter.
Do you invest across the country, or do you invest in the New England area only?
We stay pretty close to home. We're fortunate that we can. Not every region has enough density where you have that luxury. But in our view, we like to be close to the companies. We lead the majority of the deals we do, probably 75, 80% of the deals we do, we're the deal lead and we're taking a board seat. At this point, I think we have about 40 people sitting on, 45 or something board seats for us, or board observer seats or whatever. And if all those people were traveling all over the place, it would really be prohibitive. And that's really kind of our model. So we tend to stick pretty close to the Northeast. We'll look at deals in New York or, Vermont or New Hampshire. We've looked at the occasional deal in Toronto, Montreal, those kinds of things, but pretty close to the New England area.
Well, it sounds like you lead a lot of deals. You don't just syndicate or follow on like many groups do. What are the advantages of leading the deal?
We feel pretty strongly that every good deal that is going to generate a return and work out well needs a strong lead. And the main advantage of leading it yourself is that if you want something done right, do it yourself, right? So we worked hard to kind of get good at that. One of the biggest challenges I'm sure you've seen in your portfolio is companies, for lack of a thoughtful capital staging plan, end up riding a post-money valuation that they can't carry off, and they're unable to raise money, and down the road, and then everybody gets hurt, and sometimes the whole thing collapses like a house of cards. So we view it as critically important for a deal lead to put together a term sheet that is market reasonable and syndicatable, right? So you got to be able to fill the round. And more importantly, has a longer range vision, which means that the deal is done at a valuation that's going to result in a post-money valuation that the company can grow into before the money's gone, and also doesn't introduce oddities and deal terms that are going to cause friction for bringing money in down the road. So we're just more comfortable. We've written the term sheet and thought about that capital staging plan, and we're putting our person who has been on many startup boards and so forth, into that board role. Now, that said, 20% of our deals are originated by other folks we've worked with before and we really respect and trust.
So, what kind of deal terms do you find that turn out to be detrimental to these startups? I understand getting the valuation right. If you don't get the valuation right, it sets in motion a chain of reaction that makes it tougher as they go along to raise more money because it's out of whack. But what terms have you seen other people put in that make that difficult for entrepreneurs?
Well, when you get greedy, you can introduce a lot of problems for yourself. Probably the single biggest category are things that you do to help yourself that then a bigger round decides they want as well. But subtle stuff like multiple liquidation preferences are a real signal that the company has done a distress financing. High dividends can really turn people off and can disincentivize the management team. Unusual operating covenants can be bad. Just omitting key investor protections. I saw a deal recently that had no anti-dilution protection, no drag along, no co-sale rights, and no information rights, and no pro rata rights. And it was like, no one's going to want to invest in a deal like that. So I think you kind of have to have a sense of your market and put together a term sheet that strikes the right balance. You want to make sure your founders are incentivized and are maintaining a nice chunk of ownership in the company, but you also want a deal that you're going to be able to fill pretty quickly so the company's not out on the road forever trying to raise money. And you don't want any strange or aggressive terms that are going to come back to bite you when the next round says, I'll take that and more.
Well, that's great. Do you guys do follow-on rounds as well? Is that part of every investment decision, or is that on a case-by-case basis?
No, it is. People make their own decisions about follow-ons, but as I said, in a typical year, we'll do about 10 company new investments and about 20 to 25 follow-ons into the 65, portfolio companies we have, and it varies a little bit, but we're doing more and more following on lately with startup valuations being, I think, too high. So, for example, 5 or 8 years ago, we were probably 60% first round, 40% follow-on. And now we're probably the last year, we probably were 60% of our money went into follow-on rounds and 40% went into new rounds. And, it tends to average about 50-50 from year in and year out. But about half of our money and 2/3 of our deals are follow-ons.
Well, what do you find it like when you try to go help your portfolios raise the next round of funding, whether it be Series A, B, or further down the road? What are you finding out there in helping them get this next level of money?
No surprise, we're finding the same thing everybody else you talk to is finding, which is that the Series A money is really hard to get these days. I think the goalpost for Series A, particularly for SaaS companies, is much, much farther down the field than it used to be. So our job is to put together a financing plan that gets the company enough money that they can de-risk the story and change the narrative and create value for the company that allows them to raise money on good terms. Increasingly, that money is coming from angel syndicates. I think angels have sort of not only swallowed the seed round, but they've also gobbled up, a good amount of the sort of classics, what used to be the old Series A round. So, in the Boston area, we're seeing syndicates of angels doing $1.5 million, $2 million rounds all the time.
One of the new groups on the landscape I see today is what I call the micro VC, the $25, $50 million venture capital fund, whether it be committed or pledged. And they typically have a very narrow investment thesis, but you didn't used to see those guys out there. They used to have 100 or 300 million or $1 billion fund, but now you see this new group coming up that's kind of in between, where it's above angel, but it's not a full-blown VC, and they only do a certain number of deals given it's only 25 or $50 million. Do you see those guys out there, and how do you see them playing in with angels?
A couple of them belong to our group. Yeah, we do. We see those guys all the time. And in a market like Boston, there's tons of them. And they're terrific syndication partners when the thesis overlap is present, right? And they can be a terrific, we might give a company $750 or $1 million to get them started. And, they're not quite at the repeatable sales model level yet, but they've got some good traction. Maybe they're doing 80 or 100K in monthly recurring revenue. And, a $2 million capital injection will really allow them to grow. And sort of a $6 or $7 million pre-money, maybe an $8 million pre-money for that round. And those micro VCs can anchor a round like that, just really come in and put $1 million commitment into a round like that. And the angels will fill out the rest. And it works phenomenally well.
Well, the other new entrant on the scene, as you were talking, struck me as the corporate VC. Of course, they've been around for a long time, but that used to be a very small number. Now every corporation has a corporate VC, and of course, they vary widely in what they do and how they do it. But have you had experience working with corporate VCs as doing follow-ons for what you're doing or being a part of your group?
Yeah, we do. I mean, to some extent, they're like Bigfoot. People hear more about them than they actually see them. They tend to have, as you say, fairly narrow focus. But we've probably done a half dozen or more deals with corporate VCs. We just had one recently where it's interesting, actually. We funded a company and then ultimately it got sold to a big strategic. And the founders went and started a new company that's different, but in the same basic vein. And the same corporate, the VC arm, just led a follow-on round. And it's really, I think in this case, a prelude to an acquisition.
You're right. There's they invest for all different kinds of reasons, not financial, but often more for strategic. And of course, every company has their own strategic reasons. And so it's quite a diverse group to deal with and understand what the motivations are out there.
I'm a little bit of a naysayer on that because I was a public company CFO. And I always looked at these tiny minority investments as kind of not really making a ton of sense. Like if I want an asset, I should just buy it rather than drive its valuation up. It's sort of a pain in the ass to manage a bunch of minority investments. And if you own enough of a company, you end up having to roll their profits and losses into your statement. And so I never really understood it from the buyer's perspective. But I guess some companies look at corporate VC as market research and a free option. They put a little money into a company and,
Well, I found that was one of the more common reasons was they wanted a front row seat on how the industry develops. And if you're an investor, you're in there talking to the CEO directly about, well, who's your biggest competition? Who's the winner in this market? Who's coming up? How is this structured? And you've got a direct pipeline into great information on it. Maybe you can help them a little bit with strategic partnerships or relationships or what have you. But it seemed like it was more often for the market research than anything else.
Well, one thing I saw that is a model that I thought was incredibly clever is big players like Intel when they're rolling out a new chip architecture. I can remember when Intel was rolling out the 64-bit Itanium server chip. They went around to a lot of independent software companies and said, hey, we really want you to support our chip. And to incentivize you to do that, we're going to give you a whole bunch of free hardware. We're going to give you money. We're going to give you a press release, and we're going to give you some NRE, some non-recurring engineering dollars. But we're going to create a lot of value in your company by giving you that press release and that money and that hardware. So we want an equity investment at the same time so that we benefit from the upside we create.
Okay. So they used it as a partnership building program.
Yep.
Interesting. Cool.
Yeah, I thought Intel was very clever, and their VC arm ran those investments. And so I can remember, those guys, bought 200,000 shares of an independent software company I was part of at one point.
Well, that's great. That's great. Well, the last thing I wanted to cover before we run out of time here was your work on the Angel Capital Association. You've worked as the Chair Emeritus and Public Policy Chair, and just wanted to get more feedback on what you're doing there.
The ACA is an awesome organization working on behalf of all of us sort of tirelessly. Its mission is just educating angels, promoting angel investing, finding and disseminating best practices, and lobbying on behalf of angels to protect our industry. And I've been on the board of the Angel Capital Association now, for a while. I don't know, 6 years or so, and just finished a 2-year stint as the chair. Sort of took my turn at the helm, and I am now leading the public policy efforts, which is really an outreach program at the state and federal level. We have a grassroots state organization. But at the federal level, it's really about getting regulators at SEC, Congress, people, senators, and the White House economic advisors, aware of the jobs we create and the risks we take and the stimulus that we provide in people's home districts, and trying to make sure that people don't do things that would be punitive or destructive to the angel community, like change the rules for accredited investors or change the tax rules in a way that would hurt angels.
One last question, and then we'll wrap up, is what's your take on tax credits for angel investors? I've heard the plus and the minuses to those, but what's your take on that?
I think every state and city is welcome to do what they think best. And I think that it can be very stimulative. I think it's worked out very well for Ohio. I don't think there's a great case to be made that angels, need lots of helping hands in terms of tax. They tend to be fairly wealthy and sophisticated. But that said, we are really doing important work. All net new jobs in the United States are created by startups. There are plenty of jobs created by big companies, and the equal number that are destroyed by big companies are offshored. And so net new job creation comes from startups. And angels are people who are taking after-tax dollars that they've already paid taxes on, and they are giving them to job creators at 100% risk of loss. These are equity investments, where if the company fails, there's no recourse. And angels are doing that, plus putting in a ton of their own time to help these companies grow and hire people on Main Street. And, in my mind, that's pretty important work. And certainly tax policies that are punitive don't help. But things like matching dollars are terrific. And if there's a little bit of an incentive to roll over some of your gains into angel investing, I think that's good tax policy. Deductibility of losses is good tax policy. But I don't think there's a great case for angels to just get outright handouts.
There needs to be some incentive to have a return still come out of it to make sure things still stay on the straight and narrow for sure. But, well, I appreciate your taking time. What's the best way for listeners to get in touch with you?
For your entrepreneur listeners, you can learn more about Launchpad and what we invest in by just going to launchpadventuregroup.com. And there's lots of information about the group, and there's a contact form to reach me. Entrepreneurs can apply for funding. Your angel listeners can, the best place to find me and read my stuff is at seraph-investor.com, seraf-investor.com. My partner Ham and I have built up a massive content library of courses and learning and materials on the art of angel investing. And that's in connection with a software project that we created to help manage angel portfolios.
Well, that's great. Well, I appreciate you taking time to come on, and we'd love to have you come back in a little while and talk about more of these topics as they come up. And so then there's many to choose from here on the Launchpad side, the angel side, the active investing side. There's many topics you can cover today, and love to have you come back and talk about more. But I appreciate your taking time for now.
Be my pleasure. Look forward to it, Hall. Take care.
Thank you so much.
Bye-bye.